In this video, we are going to look at the lump sum study of the 50-year-old individual, and we're going to look at several scenarios. What does it look like when he takes that $1 million lump sum, moves it into a policy, and makes it as efficient as possible? We're going to look at it over 1, 2, 3, 4, and 5 years. So specifically, what that means is as follows. If we are going to look at a one pay, we looked at that in the last video, that means $1 million paid into the policy, one lump sum, non-MEC policy. So that means our death benefit will be very high in order to accommodate a $1 million MEC limit. We did solve for the minimum death benefit possible, but we do need quite a substantial death benefit to be able to get a $1 million MEC limit. I'll explain that as we go through the numbers. But then if I take that $1 million and break it up over 2 payments, that's $500,000 per year. $333,000 in change if I do it over 3, and then $250,000 over 4, and $200,000 over 5 years. Really, the purpose of this study is to show you what is the most efficient way to get money into a whole life insurance policy. If you've got that lump sum, you want to get it into the product and maximize the cash value growth. As we progress through the different videos, we will look at how to use the money, particularly for real estate with this individual. But first and foremost, we are interested in maximizing the cash value growth, because you may recall in the last video, his objective is to get that $1 million in. Can I just make a one-time payment? Well, now we're going to look at breaking that one-time payment up over a couple years, but I don't want any ongoing payments. How do I just get the most out of this $1 million and that is it? Often people do elect to pay money after the fact, that you can do that, but here we're assuming nothing goes in after the $1 million. So as we go through the different numbers, we will look at the overall design of the policy, and you'll see all of the options are with Guardian. We ran 1090 splits. So what that means is if we've got the $500K for 2 years, the underlying premium will be $50,000. If it's $200K for 5 years, the underlying premium, 10%, will be $20,000. Remember that the base premium does not show up in cash value in the first year. That takes the biggest bite out of the initial cash value. That's why the policy will take several years just to break even and recoup the $1 million. So how do we shorten that break-even period? All of these examples that you will see are run with Guardian, just based on their 2022 dividend interest rate. As we progress to the next video, we'll look at guaranteed values as well with some of the best options. One last thing I want to touch on regarding policy design, and we hit on this in the last video, is all 1090 splits, with the exception of the $1 million option, where we can take advantage of Guardian's 50x limitation, meaning I can have a 2% minimum base premium in the first year only. So in this particular example, we'll have a $20,000 minimum premium, which helps the performance, but as you saw in the last video, it doesn't help quite enough. So let's get into the numbers and have some fun, shall we? I'm going to touch on the illustrations briefly, and then we're going to look at everything side by side just to simplify this. So here is the detailed illustration. This is the one pay, just to break down where the money is going. Underlying premium, $20,000. Term insurance rider, we've actually got 2 term riders attached, a renewable term rider for $8.6 million, and then this target additional benefit. This is a 1-year term insurance rider, just about $3,000. So his initial term insurance costs are $10,000 in the first year, and they increase each year thereafter as well, up until the 7th year, or I should say the 8th year. After the first 7 years, we cut the term riders altogether. So what we've got here, the $1 million payment, there it is. Here's his underlying base premium, $20,000. Beginning year 2, net premium, net after-tax outlay, same thing. If this is you, this is your actual out-of-pocket. You pay nothing beginning year 2, 0 out-of-pocket. However, you still have the base premium of $20,000 due, and what's not accounted for in this example are the term insurance costs as well. So what has to happen in this example, years 2 through 7, we're not paying this premium or the term rider expense. The policy is paying for itself through the dividends and interest earned in the policy, the dividend piece and the guaranteed rate piece. This is referred to as a premium offset. So the interest earned in the policy is offsetting the need to pay the premium. That occurs up until the beginning of year 8. At that point in time, we exercise a reduced paid up option. This also eliminates the term rider. There we go. But what's interesting about this, look at year 6 to 7, the last premium offset year. Your growth, based on the present dividend scale, is about 12 grand. What's it the next year, once we go reduced paid up and get rid of the term rider? Look at that, about $47,000. So we cut the drag. That's often how I like to refer to it. So that's the one pay example. And you'll see that term rider reduction and reduced paid up on all of these examples, just because when we're looking at a lump sum policy option, that is the most efficient way to maximize the cash value growth. You do see that reduction in death benefit as a result, which some people don't like. Then we look at different options, but here, cash value focus. There's your premium. This is the 2-pay, $50,000. Here's your term insurance rider. We didn't need 2 term riders in this example. About $3,600 initially. As we look at this guy, here we go. Similar results, a little bit stronger performance. You can tell your break-even point is between years 5 and 7. I'm sorry, between 5 and 6, where you've paid in $1 million and now you have $1 million. If you recall what the one pay was, it was just at year 7 where you had $1,010,000. So it's interesting here, where breaking the payment up over 2 years actually accelerates the cash value performance. The reason why is this. You've got this premium over here. If you're paying $500,000 years 1 and 2, funding up to the MEC limit, this death benefit, kind of an oddball number, we solved for the absolute minimum death benefit in order to be able to attain, guess what? A $500,000 MEC limit. What's the minimum amount of life insurance, which gives me the minimum cost, so I can plow money into PUAs and see that living benefit there immediately, and I can access it if I want to. So in this example, years 1 and 2, we are covering the premium with out-of-pocket funds. In year 2, unlike the one pay, the policy does not need to pay for itself. That begins in year 3. Through 7 there, premium offset, and then reduced paid up. Same thing here with the 3 pay. There's that oddball number, 33,000 and change. I just rounded here, year 1, 334, and then 333 net a year thereafter for a total of $1 million. Same thing with the 4 pay, just with the design. There's your 25K, 250 total, 250 going in, and then here is your 5 pay. So the question is, what's the most efficient strategy? You'll notice that we did not run a 7 pay here, which we have to have that premium on this particular policy due for at least 7 years. If we go reduced paid up before year 7, what will happen? Before year 8, we'll trigger a modified endowment contract. So would it make sense if I said, hey, what if I actually fund it all the way through policy year 7? This way there's no drag. I don't want any years where the policy has to pay for itself. So could that make more sense? But then the flip side, you've got time value of money. If I get money into the policy quickly, and that begins compounding, will the interest earned exceed the premium due? Let's look at it side by side, shall we? And have some fun. So this was a lot of fun putting together. A lot of people we work with like to see this kind of stuff side by side. So what we've got first is 1 versus 2. The 1 pay versus the 2 pay. Same $1 million going in. These are the 2 illustrations we looked at. Now we don't have to go back and forth between the illustrations. So 1 million net out of pocket. And then in red, you've got the premium that's still due, but you're not paying it. So what this represents, if you see a red base premium here, it means it's due, but your effective out-of-pocket is 0. And this is paid through dividends and interest, not premium loans or anything like that. 0 out of pocket. There's my cash value. Year 7 is my break-even point. 2 pay. What do I have? Break-even point, just about year 5. So what's the actual difference here? Well, let's use our handy-dandy Excel workbook to calculate it. The 1 pay will have more money initially. Year 2, yes. So here is the cash value difference which will show how much more or less we have in cash value with the 2-pay option compared to the 1-pay option. So what do we notice here? Even with this higher base premium of $50K, quick refresher, because this was a result of the 7702 change and when Guardian updated their products, in year 1 we can 50x the base premium in PUAs. Can't do it after that. They won't even let us illustrate it. The maximum is 10x the base premium in additional PUA payments. So here we go. The 1-pay is out of the gates faster, but what happens? And you'll see a similar result with guarantees. Eventually that 2-pay takes over, and it's because you covered the premium. There's 1 year less of drag, is often how I like to explain that. So as time passes, what do we see here? Let's go down to age 85 and look at the cash value and death benefit for that matter. Cash value is over $155,000 greater in the 2-pay example. Death benefit, you've got 4.271 compared to almost 4.1. So you've got more life insurance as well. So often when we hear, can I just add a one-time lump sum and be done with it? The answer is yes. However, at the same time, it is good to be aware of this. Yes, you can do it, but here's something that might be beneficial to see. Then if it's me, so if I'm the individual and someone shows me that, then I'm like, show me what I've asked for. And then, oh, well, thanks for showing me that too. I appreciate it. Can you make it any better? The answer is yes. Let's look at 2 verse 3. And this is for a 50-year-old individual. I will add that depending on your age and gender, the optimal lump sum funding scenario will vary. If this was a 40-year-old, which we'll look at in a later case study, then the most optimal 4-year funding period may not be the most optimal for a 40-year-old. It can be a little bit shorter, 2 years or 3 years, typically 3. But age does matter. That's my point there. So here's the 2-pay, and then here's the 3-pay. Same out of pocket to the individual. Looking at everything, what do we notice here? Breaking even here at year 5. What was the 2-pay? Technically, you are positive in year 6. We crossed that $1 million threshold. So let's do the same thing here. Let's see the difference. Nice thing about Excel is once you've got everything lined up, you can just copy and paste. So here we go. What do we notice here? Years 1 and 2, you've got significantly less money, but the reason why is you're getting more money in. 2-pay, you got $500K in years 1 and 2, the full million's in. Here by year 2, you're $300,000 short, but you've only gotten in $667,000. The next year you get the full million in, and at that point in time, you've got more money, $6,600 more. If we scroll down here as well, what happens by age 85? Looking at the same point in time, there's the 4.271, but look at this, 4.4 in death benefit. So you've got more life insurance in addition to that, almost at 3.8 here compared to 3.68. So now we see a 3-pay makes more sense. Interesting. Can you make it better? Let's have some fun. 3 verse 4. So same thing, 3-pay we just looked at, compared now to a 4-pay. Here, what do you notice here? Base premium, we're covering it for 4 years. Over here, 3-pay covering it for 3 years. Now you can elect a 2-pay or a 3-pay and cover the base premium thereafter, but if you're in the situation where you say lump sum and that's it, we want to respect that and show what it looks like based on that lump sum first, and then show some additional options. Here you go. What do you notice here? Getting interesting, right? 3-pay is stronger by year 5. At both points in time, in both examples, we've got all the money in. Let's scroll down a little bit. Well, first, let's copy and paste. Who's the winner? Still the 4-pay in this case. Not by a whole lot. And this is where it gets interesting too, and people end up making a decision off of this, saying, okay, the 3-pay, I might take that because when I look at the difference here, like it's almost not material at all. When I look at the cash value and death benefit, if I go all the way down to age 85, what do you notice here? The difference is $8,000 on $1 million over the span of 36 years. So how a lot of business owners and real estate investors view this, they say, okay, Not much of a difference in cash value or death benefit for that matter. It's about 10 grand in death benefit. I do value this part though, Steve. If I can get money in quicker, that's more capital I have access to in the cash value life insurance policy instead of somewhere else, whether I plan on borrowing directly against it, looking at cash value collateral loans, maybe I'm not going to touch it, but I like the idea of getting it in quicker. This could work out where one would view this and say, okay, I get that, I'll still take this option though, because it's not much of a difference there. So seeing it up front. With that said, I would not just stop there and say go with the 3-pay option. In our next video, we're going to cover the guaranteed values as well. You're going to see a little bit of a different case there, something to be aware of, let's put it that way. But let's go a step further before we even go that far. What does it look like if we spread it out over 5 years? Because here, we've got 3 years of drag, we can refer to it as. The premium due, but we're not paying it. We funded it for 4 years. What's it look like if we look at the 4-pay compared to the 5-pay? Here's where it gets interesting. So there's your funding. There's the premium that's still due. Over here, $200K for 5 years. Premium's only due for 2 years in this particular case. Which one gives you more money? All things being equal, design ratios, company, product, health rating. Went through the illustrations there. Year 10, 4-pay. Let's look at the difference here. All the way down. At no point in time does the 5-pay overtake the 4-pay. Interesting, isn't it? Because we've got an extra year of drag and a higher premium. What's going on here is that both the guaranteed rate and the dividend rate, in this case the dividend rate, the interest earned is exceeding the cost due, to use that verbiage. Versus over here, yes, we cover the cost for 1 additional year, but getting that last $200,000 in a year slower, I'm not earning dividends on my full $1 million at this point in time. So I was able to get out of the gates faster. We can refer to that as our sweet spot. This is particularly based on an age 50 or 50-year-old male. Age or gender varies. Things can and likely will be different here. But we see that the 4-pay was the sweet spot. And if I were to take number 2, it's actually closer to the 3-pay. The 3-pay and the 5-pay are very comparable. So it's interesting when we look to find that optimal funding solution, because again, what was this individual's objective? $1 million lump sum, I want to get it into the policy, and then I'm done. Yeah, maybe I'll consider funding down the road, but let's not plan for it. I'm done. So that's exactly what we did there. We see that the 4-pay is number 1, and then number 2, you can flip a coin between 3 and 5. However, there's a couple more things we want to look at. So what we will look at in the next video is as follows. We're going to take the best options. We're going to focus on the 3-pay and the 4-pay. We're going to examine the internal rates of return, both the annual and the average. The annual will be pretty interesting when we look at what happens after we exercise a reduced paid up option, and then the guaranteed values. So I hope you enjoyed this one. If you did, please hit the like button, subscribe for more. And as always, I hope this helps. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.